Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. How are you, sir?
I am doing well. Jared, how are you today?
I am fantastic. I'm happy to be able to get together with you here again. I know it's been a minute since we've recorded. Always great to get some time with you.
I know, and it's always a pleasure, Jared. So how'd you spend your past week?
Well, we had some getaway time with the missus and I. We were able to get away and get just some time with her and I. And then it was like whenever, as soon as we got back, it was like a half a day of just all hands on deck. And then we split paths again. And she took the older two up to a concert up in Knoxville. And I've had the youngest one down here just hanging out. It's been awesome. I took our little one to the world of Coca-Cola yesterday, and she absolutely loved it.
Oh, very nice. That is wonderful.
Yeah, we had a good time. How about you? What's been going on with you?
Well, I just came back from Vermont. Our first grandson was born, Hosea. So I've dubbed him H. Sinclair because I keep messing up his name. And so, nope, he's going to be H. Sinclair. Great little kid. So we were up there a few days. Antoinette's actually still up there. She'll be coming back later in the week. But very, very enjoyable a few days up in Vermont.
That's pretty awesome. Well, if he's going to be a future infinite banker, we should get him an initial and a middle name and a last name, because apparently that's how all the famous infinite bankers do it.
Yeah.
Whether it's R. Nelson Nash or is it R. Carlos Lara? I should be J. David Adams, but I'm not. I'm not cool enough. I'll have to earn that designation.
It's a great idea. I know I'm behind. I've got to catch up. These kids have had some children, so I got to get those all in place. But H. Sinclair will get a policy, banker's policy. Oh my goodness,
I love it. Well, back to the IBC discussion. Another great opportunity here to chat and have some more conversation about what's going on. One of the ones that I had pop up recently that I thought was great, and you had some really good thoughts on this, so I wanted to lob it your way first. When you look at the cost of life insurance, do you think could you kind of run down the gamut there of what's the most expensive life insurance and then what's the least expensive life insurance? Am I saying that correctly? Is that because that was how it was worded to me? Is that your understanding of the question as well?
Yeah, it's a fair question, Jared, and most people would get this one wrong. And I think my response now is going to surprise a lot of people. The most expensive insurance you can buy in the world is term insurance for the long run. And the least expensive insurance for the long run is dividend paying whole life insurance. Ask me why.
I bet you know why. Well, let me give everybody that's listening a chance to first pick their jaw up off the floor, and maybe they just spilled their coffee. They're going to need a couple of seconds to wipe that off. Go ahead. Let's peel it back. Why is that the case?
Well, because term insurance is nothing but death benefit. That's all you're buying. There is no cash value component to it. And everything is predicated on the mortality cost. And as we get older, we're closer to our end game, so to speak. And so that if you're going to give money to an insurance company, the longer they can hold that money, the better it is for their investment portfolio. And so what happens on annual renewable term is every year it gets more and more expensive because all of us age. And so there's less time for the insurance company to have the money. And it's capped with either 10-year, 15, 20, some go out to 30 years of term insurance.
Yep.
And the longer the duration, of course, the more it's going to be. But insurance companies know, they know as a group when people are going to die. They have statistical data on that going back many, many years. And the old joke in the industry is that the Sicilians will tell you where.
That's right. That's right. Well, and just to make sure we're including some of the terms on the right pathways, right? When we say term insurance, that's typically purchased in its own bucket, right? That's something that someone is going to purchase by itself. When we throw in the term annual renewable term, that's typically down another product. Am I saying that right? Would you agree with that?
Well, yes and no. I mean, term
Yep.
insurance covers more than just one product. We could talk about it. Term insurance, there's renewable term, which the annual renewable term is the most widely known,
Yep.
where every year that cost goes up. There's convertible term.
Yes.
There's decreasing term. There's level term. All of them are the same. It's just how they fund them and the benefits that are built into them. Like a
Yep.
convertible term would be in most cases, just a level term product, and you keep it for a given number of years, say 10 years or 20 years, and you pay the same premium, and then it falls off. And one of two things can happen. You can convert that to permanent insurance for whatever the going rate is for that product at that time, but it's a guarantee that you
Yep.
can buy it. So if you are not insurable, you've locked that in. Whereas if you don't, then of course the term just goes away and you
Sure. Sure.
stop paying it.
That's a good description of all the variety that's out there, and still not even a conclusive list. There's just so many different products and variable pieces that are, just different parts of what this looks at. But it's important to differentiate that the term insurance is going to expire at some point, unless it's under the annual renewable or some of these other designations.
But why is it so expensive? It's expensive because
Yep.
after the term, and I'll just an example. I had $1 million of term insurance, level term, 20-year level term when my kids were young, and it was I think about $800 a year, Jared. It's pretty cheap. And then in year 21, it went to $16,000 a year, and then 30 some thousand dollars a year, and then it goes up from there. It's not tenable. You
Yeah.
will not. You're not going to keep that policy
Yep.
unless you're terminal and you say, hey, I'll pay the 16 grand because I'm going to die. But it's just it's there for a specific term to meet a specific need. That's generally what it's used for. It's a planning tool, but it
Yep.
is not permanent insurance.
That's right. So the other way that you could say the reason why term is more expensive is because 98% of the time, and I'm just pulling a number out of the air for
No,
that, but
that's about right.
98,
It's actually higher than that.
so 99% of the time, that term expires. And if your level term or, the standard use of the term insurance product, if that was in place, it becomes valueless that next day, and you paid all that money and received nothing for it.
That's exactly right. Yeah. Yeah. Term insurance is just to solve for X. It's a problem that you have, whether it's a mortgage, whether it's your kids are young and you want to make sure that there's money for your spouse to raise them if something happens to you. There's a specific purpose for it, but it is not a long-term plan. And anybody who's out there who says, "Gosh, I really would like to have a permanent product, but I can't afford it," well, then you might look at convertible term. If nothing else, you ought to have something.
Sure.
And that convertible term, once your fortunes change a little bit, you can convert that term. But what you can't do is 10 years down the road, if you develop a uninsurable, health issue,
Yep.
you're stuck.
That's
You're
right.
stuck. You can't get it.
I know that one the hard way. Yep.
So yeah, so
Yep.
that's term. And then if you pivot over to the permanent life insurance, that is a whole life, and then they also throw into that bucket universal life, variable life, index universal life, and those we could talk about here in a second. But that's the permanent side of the equation. And on the permanent side of the equation, the problem that I have with the universal life and all the ULs, basically the universal lives, is they include these. And I just looking at this for many years, they're very misleading. Why? Because they're not permanent in the sense that the dividend paying whole life insurance is permanent. They're derivative products. There's a underlying universal life on one side, annual renewable term, and then there is a investment, whether it's an interest bearing account or whether there's sub accounts, which gets into
Right.
the variable universal life. They got so many different derivative products out there, and you can really get in the weeds with this. But suffice it to say, it's a synthetic product made up of annual renewable term and an investment
Sure.
account. And the whole idea is that investment account will keep up with the ever increasing cost of the annual renewable term. And I'm here to tell you, I don't think a lot of these are going to hold up. I
Sure.
think they're going to explode when somebody hits 65, 67 years old. the annual renewable term is just so expensive that you would have to have blockbuster returns in your side account just to cover that.
Sure.
And so then what happens? Then you have to either reduce the death benefit, you have to increase the premium, or you have to reduce the cash values, or two, or perhaps even all three of those, just to keep it solvent. And oh, by the way, on a lot of these products, say you're paying monthly on a universal life product. If you miss one payment, a lot of these insurance companies will negate the guarantees that they throw in there on the death benefit. They can change that. It's all subject to change. That is not true with a dividend paying whole life insurance contract.
Sure. Well, there's so many different products out there. I know we could probably do a couple-hour podcast just on all of the products and our thoughts or opinions on it. But maybe give me just a 2-minute version here of the kind of a sum up, and then we can go up and start picking apart some of them and maybe dive a little further. Would that be okay?
Sure. Yeah.
So
In short, yeah. So
Go ahead.
term insurance is temporary insurance. It's the most expensive kind of insurance. It goes away. It is not suitable for long-term planning, and it's certainly not suitable as a standalone banking product. There's no cash value. The whole life permanent product, in my view, the gold standard is the dividend paying whole life insurance contract with cash values where it's paying a dividend. You're looking for a company that's been paying dividends for a long, long time, and they're an A-rated company. They're rock solid. So that's the difference. Permanent versus temporary insurance. That's kind of the gamut.
Yeah, that's
Okay.
perfect.
All right.
So if we look at just the term insurance itself, we understand that's typically a shorter period of time, has zero value at the end of it. It serves its purpose. It's cheaper in terms of your monthly cost, but it's very, very expensive in terms of what you retain from that.
Right.
But in terms of the permanent insurance, there is a whole different variety of things you can pick from there. I completely agree with you. Your whole life product, the dividend paying whole life insurance is your gold standard. And if I have to say why as well on that, you've got all the risk of a permanent product for this life insurance that you are transferring to the life insurance company with a whole life product. When you allow them to hinge it to a investment account, to a sub account, to a changing cost of insurance over the time of this permanent product, these whole life accounts that you're going to allow them to change the cost of your insurance over that time frame, that to me transfers the risk that you are attempting to cover by passing it to the insurance company. You're accepting that risk.
That's right.
So I don't understand why. I mean, I understand why a lot of people get involved with some of this stuff because they can be real sexy on paper. They can look, you can make them look like they are just going to destroy anything that was ever out there, and they're all speculative. They're all hopeful on a good performance and a good return and a good insurance performance so that they can continue to keep you at a low cost of insurance. Like all of these things are completely up in the air. Whereas when you sign on the dotted line with a whole life product, especially, the ones that we're using for the, infinite banking style setup, you are guaranteeing, locking in your cost of insurance for the rest of your life. You
That's
are
right.
guaranteed that coverage for that cost. No
Right.
questions asked. It's hinged on nothing. So, I love that we can pull some of the layers back and see some of these different parts of these different accounts. But I really think it's so simple, but yet it's so complex. It's made so complex by so many different players.
Well, one of the things I don't like that I'm seeing a lot out there, Jared, is people selling off an illustration. It's so disingenuous. An illustration, anybody who's listening to this, if anybody comes to you with an illustration and they show you these pie in the sky numbers on a IUL contract, for instance, say, hey, you put money into this thing, it's going to grow like gangbusters. And then not only are you going to be able to use this for your banking function, when you go to retire, you can pull $60,000 a year out for the rest of your life. Oh, what a wonderful product this is. That is an illustration. And I can produce one of those too. But the problem is, an illustration is only as good as the moment you print it, nothing beyond. And
Right.
the one thing that I can guarantee is none of the numbers on any illustration, including the ones that we produce, will be accurate. They won't.
That's right.
Because those numbers are going to be higher or lower. They're not going to be those numbers because it's predicated on history. And the universal life contracts, my gosh, those things just came out into vogue in the 80s, I think it was. So they really haven't been out, relatively speaking, that long comparative to the whole life contracts, which have been in existence for 150 years.
That's right.
So it's apples and oranges.
I guess you could also say, though, that even though most of the part of the illustration is dealing with the speculative portion on the unknowns, the non-guaranteed, there are a couple of columns that are guaranteed. I
That's
can
right.
guarantee you, especially on the ones that we show you, when that is 30, 40, 50 plus years from
Right.
now, that guaranteed number, I can stand on that.
That's
There's no
true.
questions asked.
Absolutely
All of the
true.
other ones that are going to be dependent upon dividends and performance, I can't guarantee those either, but neither can
Well,
anybody else.
yeah, Jared, and since you said that, and that's an excellent point, when you're looking at an illustration, oftentimes, most times, they're going to show the guaranteed and the non-guaranteed side. The
Yep.
guaranteed is merely the interest rate added, the additive effect of the interest on your money growing. And it might be only 1%. It's not that exciting. The right side of that column, that is the interest plus the dividends that are paid annually. Dividends are never guaranteed on anybody's contract.
Right.
So that's really important to understand. But once the dividend is paid, it's locked in. So you can't go backwards with a life insurance contract on cash values. Unlike that's on a permanent dividend paying whole life insurance contract, unlike an IUL product, for instance, that can go backwards.
Sure.
So, real important to understand that the risk is all on you, not on the insurance company with those other products.
That's right. Yep. So, if you had to include some factors that you might include, if you're out there shopping for an insurance product or shopping for something that you'd want to consider to use for an infinite banking style, infinite banking concept setup, you one should go talk to a practitioner. Because
Yep.
if you are truly going to set this up for an infinite banking account, or I'm sorry, an infinite banking concepts style account, you want to be working with a practitioner. And I can tell you 100 times out of 100, they're going to tell you use a dividend paying whole life insurance product, preferably with a mutually owned company, in order to set up that style of an account. Now, that doesn't mean that that's the only product that's out there, but I guarantee you that's the best and only product that you're going to use if your goal is to take care of some of the banking function, or if you truly want to recapture the interest that you're paying someone else's bank. That is your best product. You're going to see all kinds of reels or quick little videos on YouTube or fill in the blank that talk about how IULs can help create your own bank. Well, I would advise you to chat with a practitioner
Yeah,
and just start asking some questions. Is my cost of insurance guaranteed to remain the same from day one to day 60, year 60? Is it guaranteed to remain the same? See what the answer is. Is
yeah.
this hooked to an investment account? Is there any part of this that can go down year over year? Some questions that you would want to ask if you're out looking for something else.
Well, sure. If you're going to use it as a banking contract, or we don't have a banking contract. It's a life
That's right.
insurance policy,
That's right.
and it's an infinite banking concept, and you're applying the concept to a life insurance
That's
policy.
right.
Let's be
That's
very
right.
clear about that. It's
No,
not a
that's
infinite
well
banking
said.
contract. And I and
Yeah.
I and I say that once in a while myself, just loosely, and I shouldn't. But the one of the things that people need to look at is when you're using this, your life insurance policy, you're doing a collateralized lien against your cash values. When
Right.
you start doing that, that will upend an IUL contract quickly.
Yep.
Whereas a dividend paying whole life insurance contract, it will not. And then you need to look at something direct versus non-direct recognition loans. All right.
So, John, let's just walk through an example real quick. Let's say you've got a $100,000 cash value and you're going to take a loan against that. You're going to borrow $50,000 from the general funds of the insurance company, and you needed to put that to use for whatever the use was for your house. There
Right.
are two different ways that the insurance companies will deal with that, and there's different companies, different structures, right? Some of them will treat your loan and consider it a recourse loan. Some of it will consider it a non-recourse loan. We really prefer to work with those non-recourse loan style companies because if you borrow $50,000 from your $100,000 cash value, there is no change to the amount of dividend that you get at the end of the year. as opposed to a recourse loan company. If I borrow $50,000, they're really only paying me a dividend on the remaining $50,000 that are there. So you get, for lack of better words, in that example, you're getting half of the dividend that you would
Right.
have in the other account. So
Exactly right.
now, just to be fair, to give due to the other side, and a counter argument to this would be a non-recourse loan company is going to pay less dividend than a recourse loan company. Now, that's just an argument. I'm not saying that that's the best one to make. I just want to make sure we're giving it some due on both sides because it's important to know that whether you're in a recourse loan or a non-recourse loan company, it's important to know what impact you loaning from the cash value has on the possible dividend.
Jared, you and we will always go with a non-direct because I think the math works out pretty good. I think it works more favorably uh, to the
Yeah.
policyholder to get the entire dividend, even when they're borrowing money against their cash values. I just think
Yep.
it makes sense.
Yep. I mean, and it's all how you plan to use the account, right? So, or how you
Right,
plan to use the policy, right? When we set these up from a practitioner standpoint, we understand that your need for banking is going to well exceed while you're alive your need for death benefit while you're on this earth. And
right.
so that's why infinite banking concepts are such a passion for us. And because of that, because we in our home and in the way that we work with folks, we're encouraging them and making sure they understand what power they have at their disposal. I wouldn't want your dividend to change from one year to the next just because that year you decided we're going to go put a down payment on a house and
Right.
I'm going to recapture the interest that I was paying to a bank by keeping that in house. So I wouldn't want you to use the amazing power of these accounts and of these policies to be impacted on your dividend because of that.
Yeah, the bottom line, and you hit on it, Jared. You find an infinite banking practitioner. Call Jared, call me. Our website, flightpathfinancial.com. If you want to go to the horse's mouth, you can go to infinitebanking.org. There's a practitioner page there. But there's so much really bad information out there. You need to you need to have the correct information to make an informed decision.
Sure.
This is not hard. I mean, we're talking about some concepts that might get a little bit squirrely at times, but
Sure.
it truly is not hard. You're
No,
just borrowing money from a life insurance company, and they're putting a lien against your cash values, and it's an extremely efficient way to operate because it's done on a tax-free basis.
yep.
That money is growing internally tax-free. Your money never leaves your life insurance policy.
That's
Never.
right. That's right. Yeah, I mean that's really well said, and that's an important thing to recalibrate is that the concepts are so simple yet so muddled. I know we've talked about this before in terms of why does it get so muddled and we've asked ourselves that question often, and I love to go back and ponder that, but it's really important that you know exactly what you're getting into and then how simple that it truly is.
Right.
Because there's so much power in these policies and so much risk is transferred off of your shoulders that it's it's crazy not to at least just try to learn a little bit about it, even if
Risk,
you're unsure.
yeah, risk is the pivotal, most important term in there to me
Yep.
anyway. When you talk about it, I mean, let's just carry it forward. The life insurance company carries the risk with a whole life policy and a term policy. That's guaranteed premium, guaranteed cash values, guaranteed death benefit. All that is on the life insurance company, and they will make that good. Whereas if you're buying into the universal products, the universal life, the variable life, the index universal life, any of those, you are carrying all the risk.
Right.
You don't have a guaranteed premium. You don't have guaranteed cash value. You don't have a guaranteed death benefit. There is a product as a side note that we talked about before, Jared. It's called Guaranteed Universal Life, and they will give you a minimum death benefit, but it's much smaller. And the insurance, if you didn't pay this thing, if you miss one payment, let's say you hold this thing for 40 years, I mean you're paying monthly. You made 480 payments. If you miss one payment, a lot of these companies they will cancel the account. They will terminate the policy, and they
It's
keep
brutal.
all the premium. So you have minimal to no cash value in those GUL contracts is what they're called.
Sure.
So that's a sidestep. So yeah,
Yep.
there is something out there, but it's, in my view, not worth pursuing.
Sure. Yeah,
So
and like we said from the get-go, the need for banking far exceeds the need for death benefit,
it
but
does,
the product that is used to
is everything.
truly, yes, the product that is used to truly take advantage of, where those benefits do lie, and how you can make them beneficial for you and your family, it really does lie within the dividend paying whole life product. It's for all the reasons that we've said. It's the continuous known set cost. Your cost of life insurance is not increasing over the life of the policy, and you never ever want to hook investments to insurance.
No, they're separate. You should invest, but investing is not life insurance. And life insurance is about managing risk, and that's the whole reason we transport the risk from ourselves to the life insurance company. Why would we want to take that back on ourselves?
That's right. Yep.
So, now, if you have any, I'm just thinking, Jared, if anyone out there listening has any questions, please feel free to reach out to Jared or myself, and we would be more than happy. Never an obligation, no risk, no commitment whatsoever.
That's
We
right.
would be happy, even if you have a life insurance contract and you have a question about it. Shoot your question our way. We'll be happy to field it.
Yep.
We can do that for you at no charge.
That's well said. Well said. Well, we're probably at our time limit for today. I know we could go on and on. I really enjoy this topic. I'd love to keep going on this topic next time if you'd like to. I just think there's so much misinformation out there that it's easy to just start to ask some of the questions as to the why. We don't have to necessarily have all the answers, but maybe just some of the questions that you may ask as you're out shopping for various products, or you see a lot of advertisements out there. You may just know some of the questions to ask. What would you add to that, John?
I would just say understand some things right up front. Understand who holds the risk, you or the insurance company, and understand what the guarantees are.
Yep.
Don't let anybody broad brush it and say, "Oh, there's all kinds of it's going to happen. It's good as gold." Get the facts, get the data, look at the contract, look at the language, and if anything confuses you, and it always does for people because of the language that some of these companies use.
Yep.
Ask Jared, ask me. We'll set the record straight for you. We're very transparent.
Okay.
There's
Yep.
absolutely right.
Well said. Well, that's awesome. Well, signing off for this time, John. Appreciate your time. Always great to be with you. Looking forward to the next episode.
All right, Jared. Have a great Sunday. Nice talking with you. We'll catch up later. Have a great day, everybody. Great week, and good luck with your infinite banking search. And we're here to help anytime.
Love that. Thanks, John.
Thanks, Jared. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.